Good morning and welcome. We've got ourselves quite the morning today. Future slipping a little bit overnight. I do want to welcome everybody here to Trading Places Live. I'm Tom Bowley, Chief Market Strategist here at Earnings Beats, and I'll be your host for the next 30 minutes, featuring everything you need to know as you prepare for the trading day ahead. Like I said, things a little rough. We have recovered quite a bit. Futures were down overnight quite a bit, but we have picked back up and looking better, certainly than we did. There's still this slant away from growth stocks, though, and that was pretty apparent not only in the close on Friday. I'll talk a little bit about that in just a minute, but also in the futures this morning. We're still seeing, money kind of rotating away from the growth stocks and definitely toward the to the value stocks, and that's certainly created a different theme than what we're used to as we look back over the past, really not just the last year during the pandemic, but really throughout the bull market. And usually throughout bull markets, you do see growth stocks outperform. But we are in March. We do know the history of March. If you don't, we're going to talk a little bit more about it later in the show. But there's a slant historically for money to rotate away from technology, away from consumer discretionary, and into more defensive areas. Now, we're also seeing energy. Energy has by far been the leader recently, and partly because of rising, I should say, surging crude oil prices. I know overnight they were up a couple bucks, like $67 a barrel, but we have seen that reverse. We're back down to about 65 and 3/4 per barrel right now on oil. So a lot of stuff going on in the market here in the near term. Longer term, I remain very bullish. I think the biggest fear for me, if there is a fear at this point, and I don't think it's going to materialize, but I don't like it being discussed in the media because I do think that can create some additional fears, and that's inflation. Because when we look at the 10-year Treasury yield, and then we know the 10-year Treasury yield's been moving higher, I anticipated that it was going to be moving higher. I mean, I really expected with the economy picking up, it was going to move higher. But now there are folks out there saying, well, it's because of inflation. I don't agree with that. There's just not enough evidence out there for that. Yeah, crude oil prices are going up, but they were coming up from depressed lows. I mean, I think what we're seeing is more just a normalization of things, which I hope everybody wants after what we've been through over the last year. But anyhow, we'll talk about all that in a minute. Let me go ahead and first bring you up to speed, especially those of you who are new. Bring you up to speed over at Earnings Beats. If you'd like, you can subscribe to our free Earnings Beats Digest newsletter. It is published Mondays, Wednesdays, Friday mornings, usually around 8 or 8:30 in the morning, generally before the market opens. If you'd like to start receiving that, you can simply put in your name, email address, hit the subscribe button. There's no cost whatsoever, no credit card required. You can unsubscribe at any time. It's really more of an educational piece that I like to write, give back a little bit to the community. We've got thousands and thousands and thousands of folks on that newsletter. So if you'd like to be part of that, simply put in your name, email address, hit the subscribe. If you'd like to try our service for 30 days, you can click on the Join Today button. We do have a tremendous track record this quarter. It's gotten off to a rough start, but not unlike the quarter we had back in from May 19th to August 19th, when suddenly everything shifted away from growth stocks to value, if you recall. In fact, let me go ahead and, I'll get to all that in just a minute. Let me take a look at what happened on Friday, and then we'll get in, because we've got a lot of things to cover based on what's been happening in the market. But on Friday, we saw a big reversal. That's the good news. I don't think it was an all clear signal, because we didn't see money really rotating back into growth. We just saw everything coming back. So it's a good thing. I mean, obviously the alternative is we just keep seeing selling, which I don't think anybody wants to see unless you're on the short side. But it was not the, dive into every growth stock out there kind of reversal that I would have liked to have seen. But nonetheless, we did see the Dow Jones Industrial Average up 572 points, the S&P 73, The NASDAQ 197, mid caps up 59, and small caps up 30. And on a percentage basis, you can see that mid caps and small caps did make the biggest jumps back to the upside. From a technical perspective, I would say perhaps the worst technical issue is right now on the NASDAQ, because we do have a lot of those technology names, many big consumer discretionary names on this index. And that's been the area that's been targeted for selling here in the month of March. And really even then throughout some of February, second half of September, of February for sure. So we've got some work to do on the NASDAQ. And I always feel more comfortable about the market when the NASDAQ's leading. Now, we led for a long time. We outperformed by a wide margin. So you got to give it a little bit of, you got to keep things in perspective and give a little room. But at the same time, I would feel much better and much more confident about trading when we see this index begin to strengthen and when we begin to see it strengthen relative to the S&P 500. Now, one positive I will say in this is as the NASDAQ has been selling off, you can see the AD line for the most part is staying high. So just like on Friday, that was big volume, but we came back up and closed near the high. That's bullish from an AD line perspective. You can actually see that we turned back up on the AD. So that's another piece of the puzzle that we have to keep in mind as well. From a sector perspective, every sector was higher on Friday, but energy was the big leader again, up 3.75%. Industrials up about 2.33%. Discretionary was the weakest of the 11 sectors. It gained, but it only gained about 0.2%. And you can see, look at the NASDAQ chart and look at the consumer discretionary chart. I think it's pretty obvious consumer discretionary is not really in favor at this point. But once again, I would have you look at where these lows are in terms of price and look at the lows on the AD line. I'm still not sure there isn't a whole lot of accumulation taking place throughout this, but we'll certainly know more about that as we move forward in the market. Furnishings had a huge day. Here's discretionary moving down. Look at furnishings. This is part of discretionary moving up. So furnishings, home construction, both moving up. And that certainly would make you want to scratch your head and say, well, how bad is it really in discretionary if home construction and furnishings are setting new highs? And that's kind of the mixed picture that we see. And one of the reasons, to be quite honest, why I remain bullish in the market. These are not areas that would do well with rates rising, especially home construction. Why would home construction be going up if rates are going up and everyone's fearful about interest rates? So I don't know. It doesn't really play out to me. Not having a good day on Friday. It did reverse off its low, which was good, but still finished down almost 4% was renewable energy. And renewable energy was above 400 less than a month ago. And we closed at 243 on the index. I mean, talk about a quick reversal. Renewable energy certainly has been struggling quite a bit, and it continued on Friday. All right, 10-year Treasury yield. Well, as far as economic reports go, we really didn't have, or we don't have a whole lot. The Senate passed the $1.9 trillion stimulus package over the weekend, so we do have that. January wholesale inventories will be out, but quite honestly, it's way in the rearview mirror. It's a January report. I don't really know that the market pays that much attention to it, but it is expected to rise 1.3%. And for those who care, that would be a significant increase over December's rise of 0.3%. So overall, not a whole lot. I mean, I think the stimulus package obviously is a big deal, but the market knew that was coming. That's not a shocker to anyone this morning. All right, as far as looking at this 10-year Treasury yield, I mean, here is the chart, and I'm just getting a quick update here. Make sure we got the latest. So the yield, which was up over 160, is now back to 1.584. So we are coming back down. I don't know if that initial surge, over 160, is that going to be a top? From a growth stock perspective, I would hope so. I think if we reverse off of this 160 level and pull back, I think that will calm down some of the rhetoric about the higher interest rates and stymieing future growth and so forth. Listen, let's pull up a long-term chart on the 10-year Treasury yield. I mean, everyone was so upset about what we went through with the trade war, what we went through with the pandemic, and everybody moved into bonds and the yield was going down, all while the stock market was struggling. Now, all of a sudden, things start to turn. We get the yield finally moving back to the upside, and we're supposed to believe that that's bad for the market too. It's bad when the yield goes down. It's bad when the yield goes up. It's bad when inflation's low. It's bad when inflation's high. It's bad when growth stocks are, it's always bad. Everything's bad. This is good. Now, there is a distinction. I mentioned it at the open. We do have to be a little careful, because if rates are rising because the bond market is believing that the economy is strengthening, that's one of the reasons, one of the primary reasons you would want to sell bonds, which sends the yield higher. You would want to sell bonds if you truly believe that the economy, that the economic strength ahead is better than you had previously thought. Then you would want to rotate out of bonds and move into the stock market, because as the economy strengthens, you're going to see revenues strengthen at all these companies. You're going to see profits soar. And when that happens, PE multiples go up, growth rates go up. So you don't want to be stuck in bonds during a period of a growing economy. Now, there's obviously the interest rate side of it, because when you do sell bonds for an economic recovery or strengthening, you're going to see those rates go up. Now, at any point in the last 40 years, if I said interest rates are going to be at 1.6% on the 10-year Treasury yield, how often in history would you have said, wow, I don't know if the economy can handle that? It's all perspective. Yes, it's surging, but that's a good thing. We went straight down because of the pandemic, and now we're just normalizing back to where we were. If you pull up energy prices, I was talking about crude oil earlier. It's good that they're bouncing back. It means that there's global demand. The market's expecting that we're recovering. Look at where we were pre-pandemic, $65 a barrel. When we were going through the pandemic and we were heading for the Great Depression 2.0, crude oil, they were giving it away. Now we actually see demand returning. Crude oil prices get back to $65 a barrel, and now inflation's the problem. Inflation versus where, there's no doubt that commodity prices are a lot higher than where they were 6 months, 9 months, 12 months ago. No doubt. And that's going to make some of the comparisons appear as though we have runaway hyperinflation. And that's one of the things that, I'm not a huge Jay Powell fan, the Fed chief. I think he's gotten better, but I certainly was not a big fan of his from the start. But I think what he's been talking about is correct, that you're going to see some headline numbers that look really bad, but he believes it's transitory. If the Fed, some of the smartest people in the world, are out there monitoring everything that's going on and believes that any short-term effect in inflation is going to be transitory, then am I going to believe somebody who's coming on to CNBC telling me what inflation is going to do? Again, you have to understand the people going on CNBC, whether they tell you or not, there's absolutely a conflict of interest. You've got the firms like Goldman Sachs that has market making units on the one hand, that's buying and selling stocks for their clients and for institutions. And then you've got analysts that are going out meeting with companies, and then you've got the folks going on CNBC, and it's kind of like this little cycle that they got going. And I'm not much of a conspiracy theorist. I don't really get into a whole lot of that, but I do say on the surface, is there any way to look at this without thinking there's a conflict of interest? You can go back to the 2008, 2009 period when Goldman Sachs had their hand slapped for all the inner office emails and so forth, talking about, why would anybody want to buy these things, yet they were selling them to their clients. They were advising their clients to buy them. They do what, they're trying to make money in their business. They want to sell things. Do you think everybody that sells you a car believes that's the best car in the world? I mean, they're selling you because they want to make money. I think you got to take some of it with a grain of salt. Again, I'm not preaching a conspiracy theory here. I'm just saying you got to understand their relationship and the way their firms work and so forth, and understand what they're trying to do. But looking at this crude oil right here, I mean, we were giving oil away April of last year. Now we're back to where we were during the secular bull market, 2016, 2017, 2018. We got as high as $75 a barrel, went as low as $45 a barrel. That was basically our range while we were fine. Now we're right back there with still historically low interest rates, and all of a sudden it's a big problem. It's just, I don't know, it's the way you spin things. It's short-term memory, long-term memory loss, I guess, is maybe part of it. I remain bullish, and I guess you can say that, I'm permeable. I don't feel like I'm permeable. I just feel like the market goes higher much more often than it goes lower. And so I look for signals. I didn't really see anything other than, actually, I shouldn't say that. I mean, the IWF, IWD, I've talked about for a long time. 1.69 was a big number. We went below it. I don't think we stay down, but in the short term, I do think that maybe has spooked the market a little bit. Throw in the seasonality, the fact that earnings season now is behind us. We still got some time before the next quarterly earnings come in, and you can justify a little bit about what's going on, profit taking and so forth. But one other thing I'll look at here on the commodities I think is really important is watching copper prices. I mean, copper prices, it's not like gold or silver, certainly not like gold, and maybe a little bit like silver, but copper really, the only reason copper goes up is because of the anticipation of economic activity picking up. I mean, that's what you're expecting. And so copper goes up when there's demand for building. I mean, I talked about furnishings and home construction earlier. I mean, when you see those kinds of things going higher, it's because of economic activity as we move forward is expected to expand. Same thing with copper. And if you look long term, when copper is rising relative to gold, that is generally a great sign for the economy. And you can see throughout, the trade war, throughout the pandemic, this ratio was going down. But since then, it's going straight back up. And this ratio, watch that 2017, 2018 high. We're not far. And a breakout there would be incredibly bullish for this ratio and for the market in general. All right, I'm going to look a little bit at the S&P 500. Let's look 5-year, because again, we're getting caught up in the last 2 weeks, 4 weeks, or whatever, and sometimes we need to take a step away. Back in November, when we did the portfolio, our draft for our portfolios, and then again in January when we did the draft for the ETF portfolio, and then again in February when we did the draft for all of our stock portfolios. In each of those three, I talked about the fact that I was very bullish. I believe the market was going higher. The real question was going to be what leads the market. And that was if there's one thing that maybe keeps me up at night, that's it. It's not whether we go higher. I believe this market's poised to go higher. I think there's a ton of money that's going to rotate out of bonds. We've already seen some of it, or we're seeing a lot of it. But that money is going to eventually go somewhere. It's either going to go back into bonds, send the yield way back down again, which I don't think is going to happen, or it's going to go into commodities, which I think some of it has. The commodities that it's going into, though, would suggest economic recovery. It's not going into gold. And then the final thing that I would be looking for is equities, global equities. And I think that's where the lion's share of this is going to eventually wind up. I think it's going to wind up in the stock market. So we've been through the trade war. We've been through a 100-year pandemic. And, now, again, when we pull back for a couple of weeks, everyone's getting bent out of shape. Lots of different stories about why we're going down and why it's not going to stop. And, brace yourself. And I just don't see that. I just don't. Could we see more rotation? Yes, that definitely could happen. But I don't see the overall market taking a major hit. And when I say major, I'm not seeing a 20% correction here. We're probably 10 on the NASDAQ. Let's see where the NASDAQ was. Probably getting close, if not there. We were 14. Yeah, we were definitely more than 10% at the low on Friday, but we did recover. I don't know if we're probably close to 10% now, maybe just under 10%. But that's a pretty hefty correction. And when you look at the weekly charts, we're in an uptrend and we're testing the 20-week moving average. I mean, if you go back and you look from 2016 through 2018, I mean, here we came down below the 20-week moving average, here a couple times, just a little bit below. But for the most part, we were staying above the moving averages. Even here, we had a maybe 1 or 2 week period where we moved below. So could we see that again? Sure. I mean, we could have another, I mean, it's March. This is when we tend to struggle a little bit. I'm going to show you some numbers here in just a minute, but this is a month or a period of time. There's no earnings. There's lots of negative headlines. There's just not a lot to drive the market right now to the upside, other than the fact that we're in an uptrend. So we'll see what happens. I think short-term market remains a little dicey. Certainly the rotation remains dicey between growth and value, between S&P and the NASDAQ. But I'm not questioning at all whether we're going higher or not. That to me is still pretty clear. I believe we go higher. If you ask me where we're going to be in 3 months from where we are right now, I think I would say we're higher than where we are. 6 months from now, higher. 12 months from now, higher. I just don't see much on the horizon. We haven't even gotten into the true growth, in my opinion. When we start seeing a lot of the headlines where growth forecasts are being raised, that's going to come after institutions have their stocks, by the way. That's not going to come out now. Right now, we're in the fear mode. Once the market starts rebounding, then we're going to get the news. Then we're going to get the, oh, by the way, the GDP has been raised, which will send the market even higher after, again, institutions are in. What else do I want? I want to take a look at the IWF, IWD. And I don't like looking at these on candlesticks. So here was that 1.69 high. Here was a couple of tests of 1.69. We selected our portfolios on February 9th, or as of February 19th. February 22nd, the day after we selected our portfolios, we broke down this IWF, IWD. Timing wasn't great for us, but I do believe we're going to rotate back up. I don't know, again, how low we go. I would be watching maybe this low on a closing basis. Let's stretch this out a little bit. Let's go a few years here. I mean, you can see this was a pretty big, remember that June, I said May to June was a bad time for portfolios when everything shifted to value for 3 weeks. That is what it looked like on the IWF, IWD. That was a pretty big low that was established there. So I do want to watch 155. I think we got down there intraday, I think on Friday or close to it before we turned back around. But that's going to be a level I would be watching. And then the April low as well. So 150, 155, look for a little stabilization, sideways action, and I think a breakout to the upside. That's what I'm looking for. Let's talk a little bit about seasonality now. I had someone write to me and ask about, because I had been talking recently about the XLK. Remember, I was showing the XLK seasonality. Now, this is a 5-year versus the S&P 500. I'll tell you what, let's get rid of the S&P 500. I just want to do a quick little refresher here for anybody who wasn't listening to the show. But the last 10 years, first of all, you have to understand that technology leads secular bull markets. It's not leading right now, but we're in a consolidation phase. We're in a rotation phase. When the market goes back up and we start breaking back out to highs, if we don't see technology doing well, that to me would be more of a concern than anything I've seen so far. You want to watch those aggressive groups. So technology, consumer discretionary, communication services, industrials, financials. Those are the 5 that I watch closely. They don't all 5 have to be leading the S&P 500, but they all 5 do need to be in uptrends. And I'd like to see at least 3 or 4 of them leading. That makes me feel pretty good about the market moving higher. All right, so here's the last 10 years. And I just added up the first month of each calendar quarter, okay? And when you add those up, you get 8.7 on the XLK for the first quarter, or for the first month of each quarter. The second month of each quarter, you add them up, you get 9.6%. And then the third month, you get 2.2. So it's a big drop off in March, June, September, and December for technology. Now, last week when I was talking about this, I annualized it and I said, you take, say, the first months of each calendar quarter, January, April, July, and October, and you add them up, you get 8.7. And I said, multiply it times 3 and you get 26.1. That's kind of like what it would be on an annual basis. And I had a couple members write in and say, why am I multiplying that times 3? Why wouldn't I do 4 since there are 4 quarters? And I'm not looking at the quarter. I'm looking at 1 month in each quarter. So I'm looking at 4 months. So to get to 12 months, you multiply by 3, not by 4. So I just want to be clear and clarify that for anyone who wasn't following that. So that's why I multiplied times 3. You're adding up the 4 months out of the year. So to get to 12 months, you have to multiply by 3. If you multiply by 4, it's going to be 16 months that you're looking at. That's not right. All right. Now, the other thing I want you to look at, and I found this very interesting. Let's pull up utilities. Now, remember, secular bull market, rising tide lifts all boats. This is a defensive group. This is the absolute performance on the utilities going back the last 10 years. And I did the same thing. I went through and I added up the first month of each quarter. And I was actually shocked that on the XLU, let me see here, 3.7, 5.6, 8.4. The first month of each calendar quarter, utilities actually have kept up with technology. I did not have any idea. I would have never guessed that. So I learned something new this weekend. But the second month, February, May, August, November, have all been averaging lower for 10 years during a secular bull market. So if you add those up, it's minus 2.5%. And then you go into the third month, and the third month is 3.7%. Now that 3.7% is better than technology's 2.2% if you add up those, the March, June, September, and December months. So we do see that shift to more defensive areas in the third month of each calendar quarter, which we are in right now. So what we're seeing, and some of this rotation, is actually kind of normal from a historical perspective. So I think we need to be aware of that. This isn't something completely different. And if you were trying to get shares for institutional clients going into next earnings season, would you want to see lower prices in the month prior? I would. Again, I'm not throwing a conspiracy theory out there. I'm just stating the facts. These months tend to be much more defensive. Money rotates. We're getting bad news coming out. Inflation fears, interest rates are going crazy. Look out. I don't know, just something I think that's important to keep in mind. Now, I have not looked at consumer staples yet. This is going to be the first time I've actually done this. Actually, before I do this, let me take a look at the utilities and compare it to the S&P 500, because I find this over the last 10 years to be pretty interesting. Look at March. The utility group over the last 10 months has outperformed the S&P 500 80% of the time in a secular bull market. I wouldn't be expecting, look at all the other months. Look at November. Only one time in the last 9 years have we seen utilities outperform in the month of November. History matters. Historical periods, seasonality matters. All right. If we drag it back 20 years, the XLU versus the S&P 500, you can see March is a very strong month for utilities. Let's pull up the same chart for staples. And over the last 20 years, not quite as good. Still, you can see the third month, March, positive versus the S&P. June is even. September's positive. December's even. So consumer staples doesn't perform poorly in the third month. That's another area that performs pretty well. So anyway, keep all this in mind, that some of what's taking place here is kind of typical of what we see in the market. Let me get rid of this, and I'm going to pull up the XLP. Let's look at this from a 10-year period. So I'm actually going to jot these down because I have not done this before. But the XLP, if you look at the first month, 1.4, 3.9, 4.6 in the first month. Second month, 0.5, that's 0.4, 0.3, 2.6. If you add in a pretty strong November. And then the final month, 1.2, 1.5, 2.7, 3.0, 3.1. I mean, when you look at consumer staples, first month of the calendar quarter, 4.6%, second month, 2.6, and third is 3.1. And you might say, well, you know, it's not really showing any favoritism. But if you look at how the S&P 500 does during those same months, I think you'll see that the relative strength of consumer staples is very strong in those third months. Anyway, I just want to pass along. I think it's kind of cool when you look at how the market works. Always keep that in mind as you're going into that third calendar month. You're too far from earnings coming up, and you're already got the prior earnings in your rearview mirror. So I think it's a, you know, buy on rumor, sell on news kind of thing. We've gotten past earnings, so we're going to sell some of those growers. We're going to move more into defensive areas, going to scare the heck out of everybody, and then we're going to start, institutions going to start buying when everyone else is selling, and then we start into an earnings season again and rinse and repeat. That is, in essence, I'm not saying it happens every quarter, but in essence, that's kind of the cycle that we go through historically as we work our way through each calendar quarter. All right. Last thing, 3 you must see. I'm going to just go into the dashboard. We have it open. Let's see where we are. Actually, not bad action at all, considering where we were overnight on the futures. I thought maybe we were going to be down a couple hundred on the NASDAQ, but only 31. We'll see if we recover. But again, watch that ratio, IWF versus IWD. Watch the NASDAQ, the QQQ versus the SPY. Those are 2 really important relative charts to follow when you're thinking growth versus value. When they turn up and start moving higher, I mean, we can hear whatever we want to hear in the news. They can't, if they are trying to cover up something in the news, they can't do it on the charts. That's why, for me, the charts are so much more important than tuning into CNBC. You cannot cover up what you're doing with your money. It's showing on the charts. Right now, money is rotating out of growth. When that line turns up, money is rotating back into growth. I don't care what you're saying on CNBC. That money is turning back up. So anyway, last thing we'll do, I'm going to pull up, let's do the S&P 600. This is going to be small caps. And I'm going to do maybe most active. GME up another 18. Okay. So we got the GME thing working again. Let's look at that stock, see what's going on here. You know, I'm scared to death of this. I'll be honest. I don't know what the right value is for this stock. When you get a stock that goes from $6 to $500 in 2 months or 4 months or whatever it was, and then it goes back down to 40, and then it goes up to 175, and then back down to 90, and now it's back to 160. I don't think anybody knows what the value is of this stock right now. So I am just ignoring it. I don't like to gamble. And this is a pure gamble in my opinion. There's still heavy short interest on the stock, by the way. So if it does break out, I would say above 170, you could see another big run, just because anybody who's on the short side that follows technicals is probably going to be a little bit more nervous if we break above that 170 level. That's the candle body high. Intraday, it's 184.68 if you prefer intraday. I tend to use opens and closes. All right, so that's GME. Let's see, next one, Macy's. Macy's has made a pretty big run. We were up to 22, pulled back. I would be watching maybe a close over about 1606. That's your candle body. We're at 1565. I think, you know, we got an uptrend. We got consolidation after an uptrend. This is pretty bullish look, I think, on the chart. If you get that breakout, 1606, I like it. Or if it comes back down to around the 14 area, you get a 50-day test. I think that would be an interesting area if you're looking at Macy's. And then the last one we'll look at, we'll wrap up here, is IVR, which is Invesco Mortgage Capital. Not really seeing a whole lot here. Look at the high we had in June, high we had at the end of January. just kind of sitting in maybe a little triangle here. I'm not really liking the stock. I mean, we do have an uptrend here. So as long as we hold 350, I'm okay. I just think there's so many other stocks out there that I think look better than this. So I would pass on it. But watch 350 to the downside. And if we can break this trend line to the upside, so maybe a move through about 410, 415, something like that would start to get my attention to the upside. All right, that is it for today. Appreciate everybody tuning in. We're going to be back tomorrow over at Stock Charts TV for your next Trading Places Live. Buckle your seatbelts. We'll see what kind of volatility we get this week, but hopefully I'll be able to recap some of it for you in the morning. Take care, everybody. Happy trading.